Welcome to the After 5 p.m. podcast, where we clock out of mortgages at 5 p.m. and clock into life, family, and finances. We're here today with Ben McAfee and myself, Shaun Russin.
Sweet. Give a little bit of insight on the name of the podcast. I know we've hit it on a few others, but After 5 p.m., Shaun and I used to work together for the same mortgage company, and we had some really good conversations after the daily grind and the phones are ringing and all of that. Come about 5 o'clock when things calm down, one of us would pop our heads in the other's office and maybe pose a question or a scenario that you wanted to bounce off of each other, and inevitably would turn into some awesome conversation, not only about our professional lives, but our family lives. And that's why we started the podcast. We both work for different mortgage companies at this stage, and we kind of miss those conversations and that collaboration. So why not start a podcast, turn on a mic, and pick up where we left off. So today we're going to talk about down payment assistance, also abbreviated out there as DPAs. They're different. They're different all over. You have some local DPAs, state DPAs, as well as nationwide products and options. One of the reasons why I wanted to bring this topic up and talk through it is here in the state of Utah, we've had I don't know the exact time frame, but over a year ago, a new down payment assistance program became available called SB 240. And as we talk through some of my referral partners here locally, they think that SB 240 is like the only option. The reason why SB 40 is kind of tough is it's set aside for new construction under 450 on a price point. And if you were to go pull the MLS today, I bet you could count on two hands how many properties are actually listed for new construction under 450. So just extremely limiting on what's available. And so I ended up doing a sales training for a group of real estate agents that kind of went through some of the other options that kind of open up the bandwidth for buyers and the products that they might be interested in buying. When I say product, homes, right? The other homes. So Shaun, let's chat through. Maybe can you give me kind of historically in your career, you've been in it long enough, what have been some of the more common ways to get 100% financing? Because what a DPA is usually covering the down payment necessary that the first is requiring, right? Mm-hmm. So, or 100% financing. Talk to me about what maybe some of those traditional products have been.
Yeah, so if you're looking to get into a home with no money down, just traditional products, the most popular one I'd probably say, or the most recognizable one, is like either USDA or VA. So a USDA loan is 100% financing, so no down payment is required, but you have to be in a rural area determined by USDA, and then there's an income limitation as well. VA, that's for active duty or military veterans. 100% financing, no income restrictions, really no geographic restrictions either. So those were the two kind of main ones. And then you highlighted Utah Housing. Since I've been doing loans for 10 years, Utah Housing's been around since then. And then kind of over the past 10 years, there was a grant program that would pop up. They would have funds and they would run out of funds, and those would kind of come and go. The 5 counties, I don't know if you remember that one.
Oh, yeah.
That was kind of the first one. So I would have borrowers, hey, are there any grants available? And I feel like it was more popular, or there was more options when I first started. But now there are still options. Most of them aren't like government backed, but there are a handful that we can get into. They're more kind of niche products that I'm seeing now.
So my takeaway talking to these real estate agents in that sales group and some other independent conversations, I just realized there's way more tools in the toolbox than what I think some of our realtors are aware of. Mm-hmm. So I think just talking through it is great to know what else is out there, because each program has their own rules and requirements. And just because it doesn't fit into one doesn't mean that there's an option that they would fit into. It's just a different batch of pros and cons.
Yeah.
So I love the highlight of USDA or rural housing, different names, same product, right? VA, one of the best loan programs out there, but obviously very limited on who can qualify. Must be a veteran, and that narrows down your population of people that can qualify. I want to explain a little bit more with the Utah housing. Utah housing is, and I think most states have some kind of program like Utah housing. I know Idaho has one. But what Utah housing is let's say you're pursuing an FHA loan, and we're going to do a standard 96.5% first mortgage, which is a standard FHA minimum down. They would come behind and say, hey, we're going to issue a second loan for 3.5%. So if you add the first and second mortgage together, it's 100% financing. And they even go a step further and say, hey, we'll even allow you to finance some of your closing costs. So we're going to actually go above and beyond on the total loan amount to be greater than the purchase price, to help first-time home buyers, get into their homes. Some of those problems that you run into is Utah housing has some income limits that higher income earners can't tap into that program. So that's the Utah housing. That one's been around for as long as I remember. I don't know when that program started, but I think long before I started in my career. And it was only a year and a half ago that the state legislature passed State Bill 240. State Bill 240 was basically saying, hey, we're going to set aside this batch of funds to help as another down payment assistance program. But what's unique about it is what they refer to as a silent second. Silent second says, hey, we're going to give you that down payment, the same as the standard Utah housing, but we're not going to require you to make a monthly payment on this money, and we're not going to accrue interest. So there's a lien against the property. They're going to require it to be paid back, but it's a cheaper, more economical option than the standard FHA down payment assistance because no accrued interest. So it's a cool product, right? But like we talked about earlier, has to be new construction, has to be below 450, and that's just the way the state bill was written. Mm-hmm. So state bill, I think there was probably some strategy in there. It makes sense that they're trying to encourage builders to build a more affordable product for first-time home buyers, and this product would definitely help open the door to many more buyers to move those properties. But I also haven't seen in the last year a huge influx of properties being built for under 450.
Yeah, especially in Washington County. It's like, I think you mentioned that earlier, is to be under 450, you're a really small townhome possibly, or a condo. And then the tricky part with condos is if it's not FHA approved, then you lose out on a big buyer segment too.
Yeah.
So
I don't know what the actual projections were from Utah housing standpoint. So to clarify, Utah housing was asked to facilitate the SB 240 down payment program. So it's the same entity helping manage both of those down payment assistance. So when I reference in the podcast Utah housing and SB 240, they're because they're facilitating it. That's the connection. Mm-hmm. I don't know what their forecast was on how quickly they would burn through that money that was set aside for that down payment assistance. But I guess I personally thought it would move quicker. So there's still money out there available. So if there's any listeners that are interested in these down payment payment programs, please reach out to Shaun or I. We'd love to help let you know what's available and what your particular scenario, what would be the best fit for you. But so those are some common ones. What other programs are you available that's out there?
Well, just since we're on the SB 240, because that's one I'm getting. If I ever have a client bring or like question this, usually it's like, hey, I heard about that $20,000 grant thing. And so just for consumers or for real estate agents, the $20,000 is from the legislature. Those funds are provided then through Utah Housing, and then at closing are used towards down payment. Is that correct?
Correct.
Okay. So if you do have a lender you're working with, not all lenders are Utah Housing approved.
Correct.
And so the loan, to be able to take advantage of that, it has to be a Utah Housing approved lender, and then Utah Housing is actually going to issue that. And then you also have to get your first mortgage with Utah Housing, or at least the loans through Utah Housing through the approved lender. So that's another kind of, fine detail item is you can't just go to any lender and, hey, I got 20 grand I can use. However, you have to go through Utah Housing's box.
Right.
And Utah Housing has different lending overlays, different income requirements. There's a whole, additional list on top of FHA guidelines that you have to follow that you may not qualify for, traditionally with FHA.
Yeah, I think that's great to point out.
So, just wanted to highlight that. The other thing too, and I think it is important to bring up, we talked about it before we started, the $20,000 grant you mentioned is a silent second. So it's great to get that $20,000 is 0% interest, but if rates were to drop down the road, you have that lien on your home still. So if you want to refinance, that money does have to be repaid. So there is a lien. So when you go to refinance, those liens are all paid off. So in order to get a new loan, those liens have to be free and clear, repaid, and then that new refinance lien will take priority on that. So if someone wants to go refinance down the road, that's got to be addressed somehow.
Yeah.
So for some home buyers, they may not have that money now, and they may not have it then later, right? So when you're meeting with a lender, make sure that they're analyzing your financial picture to make sure that, hey, if you're going to take advantage of that, it doesn't hinder you down the road, and it helps your financial situation most.
Yeah. So you're talking about if rates drop.
Yeah.
Well, there's just because rates drop, the equity question is how fast are home values likely to appreciate.
Mm-hmm.
So these down payment assistance programs are great to help you get your foot in the door.
Yeah.
But sometimes they can pigeonhole you and not being able to take advantage of what the market is offering because you don't have the equity, so therefore you can't take advantage of the lower rate.
Mm-hmm.
So I just wanted to unpack that you could probably pull all sorts of different studies that give a range, but you could probably assume a typical market would probably have somewhere between 6 to 8% appreciation per year.
Mm-hmm.
So if someone's needing a 3.5% down, within a year you'll probably have that 3 or 4% equity to be able to qualify for a standard FHA refi.
Mm-hmm.
But in this market, our current market where we're at here in June of 2024, we might not have that 6 to 8% appreciation like we've seen in years past.
Yeah, and I just highlight that just because it's getting a lot of buzz. It can be a great product and great incentive for the right home buyer. Probably somebody, at least from when I peel back the layers, it's probably a family or somebody that's going to keep that home long term, and their payment is in their budget and they're comfortable with it, and they don't plan on refinancing or selling. But it's just good to know how the details work versus, it's $20,000 free money, let's do it. They sign up for a 30-year loan and then might run into issues down the road.
Planning, right?
Yeah.
Just planning.
Yeah, and your mortgage advisor who you're working with should explain that to you. And then when we kind of dive into a few of these other options, explain the pros and cons, go through your individual situation and see if it's going to be the best fit for you. Because sometimes if you have even a little of a down payment, sometimes these programs aren't the best fit for you. You might get a higher rate, right? It might seem good at first, but peeling back the layers, doing a deep dive into that individual borrower situation and really seeing what's best for them is really important. Finding a lender that's going to do that for them.
Yeah,
on such a big investment, like a home.
And if you're maybe a first time home buyer or looking to purchase your first home and you're doing some market research, I think it's important to separate the distinction between a down payment assistance and a grant. A grant is usually free money that if you qualify for it, the money is issued, which is usually some kind of government entity that's trying to stimulate growth in an area or whatnot that's giving these grants. But that is usually free money that will never be required to be paid back. That's the definition of a grant. Down payment assistance or DPA, you're generally paying that back. Mm-hmm. Or you have some kind of payback term, but it's contingent on you living in the home for so many years or whatnot before you become eligible to have it forgiven. So Just want to clarify the difference between the two.
Yeah, it's important to point that out because, yeah, there are options, and we can get into a few that are free money, literally, that you can use towards your down payment. You don't have to repay, and if that fits your situation most, hey, yeah, take advantage of that. You know, if it can help you, and you can get you into a house,
yeah,
do it.
So let's talk through what some of these other programs that are out there for down payment assistance.
Yeah, so there's a couple that are similar. The Chenoa is a really popular one. That's a nationwide one. And then Essex. Those are both FHA first mortgages. And then there's a second mortgage that comes in from these entities to fund the down payment, to bridge that gap of that 3.5 down payment that FHA requires. So you would have a first mortgage with FHA and then a second for that down payment.
So if you had a borrower coming to you and you were analyzing these for a purchase here in Washington County, Utah, when would a Chenoa fund down payment assistance be preferred or ideal over SB 240 or Utah Housing?
Yeah, Chenoa, what I've found, if maybe, because Chenoa doesn't have an income restriction, so Utah Housing limits you based on your household size and then which county you're in on how much you can borrow and then how much money you can make to take advantage of that grant. So if they are outside of that range, or if they fall under Utah Housing's credit requirement, I think it's 640 or 620, Chenoa, at least what we offer, can go down to 600. So someone that's got a little lower credit score, maybe a higher income earner, or something that doesn't fit in Utah Housing's box, that's usually when we'll look at Chenoa.
Yeah. So I feel like Chenoa and Essex, both are very similar in that there's give and take, right? If you're opening up the bandwidth, allowing someone to have a lower credit score to qualify, or you're not having an income requirement, which allows them to increase their threshold on properties that are going to fit within that window, what are you giving up? Well,
you're giving up something.
You're giving up rate, right? So the second mortgages that are helping with the down payment are going to be naturally higher in the rate of the second. Some people may look at that and go, "Oh my gosh, that's so outrageous. Those are so high," right? Which can be 2-3% higher than the initial first mortgage. But regardless, it's creating a pathway to get into a home that you otherwise wouldn't be able to.
Yeah. Yeah, because if you say you have lower credit, so you had something, a recent derogatory or a recent bankruptcy, to be able to get into a home with lower credit, even if the payment's higher, as long as it still fits within your budget, to start building equity, get a mortgage on your credit, start rebuilding your credit, and then, anytime especially even Utah Housing, even if they've got good credit, for me at least, I'm always doing that mortgage planning of, hey, this loan, there's a second. So if you're going to pay extra, pay the second down. That's going to be instant equity, right? Mortgage planning through that. What does the next 2 to 5 years look like? You're going to have mortgage insurance with FHA. You can't remove, right? That's going to be on for the life of the loan unless you refinance out. So we're always trying to say, hey, if we do have to just start with one of these, let's look at doing a refinance or keep that on the back, in the back of our minds to get out of that mortgage insurance, to get you into, possibly a conventional loan if we can, and lower your payment or put you in a better financial product down the road.
Yeah.
So
I think that's great advice. I've actually had individuals that really did have enough money for a down payment. The difference was it drained their bank account down to nothing. And I just don't feel comfortable as a mortgage loan officer putting someone in a house, and it's obviously up to the consumer, right? But I always feel a little bit uneasy when they're using every penny of their life savings for the down payment, and oh, by the way, your house payment just doubled because you were renting paying $1,000. Now your house payment's over $2,000.
Mm-hmm.
So they're increasing their spending and also eliminating all of their savings. So I've had several clients that have chosen to do some kind of down payment assistance. They know the interest rate's going to be a little bit higher, but it gives them the peace of mind that they got some money in the savings account.
Yeah.
Which, as long as they keep that money in the savings account, the refi option is still available, because at that point in time, they could literally pay off that second, refinance the first, recalibrate their financial situation, right?
Yeah.
But it's those that you that don't have a plan B, that really can pigeonhole themselves. But,
yeah, well, that's a great point. And to the same point, so say someone's buying a house for $400,000, maybe a starter home. They're doing 3.5% down. That's a little over $12,000, right? $12,000 in a payment, assuming everything's apples to apples, is going to be a little over probably like $100 a month. So for some clients, and when I was getting started, a lot of my buddies, I was in my 20s, they're buying their first home. They might have 10 or 15 grand saved up. But when we would run the numbers side by side, for them to save $100 or keep 10 or 15 grand in their bank, that made a lot more sense for them to have that money in reserves and just have that safety net, especially when they're making a big commitment on their first home. Yeah. And looking back, and the market kind of went on a tear too, but some of those people, like my buddies, they had 20% equity when we go to refinance. They've had the home for 3 or 5 years, and now we can totally eliminate mortgage insurance. They're getting a better rate, their payment goes down, and they're like, yeah, I'm so glad I, didn't put that money down, because now I just naturally the appreciation put me in a better spot.
But then you have the other consumers, which is great for the person who's disciplined.
Right.
But how many of our consumers go, oh, we want to keep it in the bank, and then you see 6 months later they're buying a brand new car, and then
right.
They sunk the money into the car. So the key is sticking to the plan and having that security. If someone has a tendency to spend and have some maybe bad consumer habits, I'll always encourage putting it towards the house, because you can never go wrong with retiring debt, right? Yeah. Or shrinking your debt. So food for thought on that. So there are some of these down payment, and we don't necessarily need to get into each one and which ones are and which ones aren't. But there's a lot of down payment assistance programs that will, if you live in the home for a certain period of time and keep that mortgage for that period of time, will eventually forgive the second mortgage. I just want to highlight that's I think that should also be part of your planning, that if this is a home that you plan to be in for a year or two and you're going to outgrow it and need something bigger, or moving across country for a job that's on the list, those type of conversations need to be had with the LO so they can put you in the right one. Because if it's a home you're going to be in there for an extended period of time, why not put somebody in a down payment assistance program that can eventually be forgiven?
Yeah. And if it's, say that 0% interest loan too, if you don't have to repay that or pay any interest on it, that could be a great option.
Right. I'm trying to remember the details of which one I was looking at recently and what their timelines were that they had to live in. I know it's usually years, right? 3, 4, 5 years. And some of them are even scaled that a portion of it, a percentage of it, will be forgiven based off of how long you lived in it. So just know there's lots of options out there.
Yeah, the one, there's 2 points I do want to make. So there's the one that's really popular right now is the up to 2% of the purchase price capped at a certain dollar amount depending on your area. That is, it's either coming from specific lenders or it's a Fannie Freddie grant. That's a 100% non-repayable grant. You do have to be a first-time home buyer most of the times, but definitely if you're looking or interested in down payment assistance, that's one that's popular right now. Free money. You don't have to live in it a certain amount of time. There's that one's pretty much no strings attached, which is great. The second thing I do want to point out is some lenders don't have access to this. Some banks, credit unions can't access this. So if you are on the hunt for a grant or looking for that, or if you're a realtor looking for a lender that has it, I think it's important to make sure they do offer it or have a lot of options for your client, because one product may not be a fit, but the other one might. And if you're not looking for that or don't have access to it, you might be missing out.
No, I love it. Just because you talk to one lender, not all lenders are the same and have the same products, and so I love that suggestion. I do want to actually highlight a couple other things that you just made me think of. Again, we're going back to Utah Housing being the entity that facilitates. They're not the ones that are necessarily issuing it in regards to where the money's coming from, but they actually have a first-time home buyer grant for veterans.
Yeah.
That one, again, grant free money, and it goes towards your, so not only is the VA loan that you're doing 100% financing, but then you tack on $2,500 towards other closing costs. Just an awesome grant to be aware of and take advantage. If you're a veteran looking to buy your first home, they also have a first responder one as well.
Yeah. Yep.
So it there's programs out there. Make sure you're hitching your wagon to somebody that is going to turn over all the stones and get access to the free money or reduce down payment to help you get into a home.
Yeah. Yeah. The other thing too is, say someone doesn't qualify for these for whatever reason. The other way to get into that is you can always go get a gift. So that's really common right now too. And sometimes getting a gift from like a family member for that down payment can actually make your financial situation a lot better. The payment's going to be lower. Sometimes if it's just a true FHA loan or a conventional loan, that you're going to get maybe better financing terms, a better interest rate. So that could be something too. If you don't fit in this box, a lot of people don't know you can get a gift for the difference. Yeah.
Yeah, I would say there's a good portion of my clients that have someone in a family that's helping in some way or another. Mm-hmm. Tell me, how do you navigate those conversations?
The gift?
Mm-hmm. When you feel like a gift may be more appropriate for a client than down payment assistance, I'm just curious how you navigate that in the conversation.
Yeah, I mean, with the pre-approval, we're doing a pretty deep financial dive on their situation. But I'll just bring it up as, hey, if some of these don't work for you, there is always the option that we can get a gift for the down payment. That might actually put you in a better financial spot. And depending on the product too, or the home they're looking at, they might, some of these don't allow like a manufactured home or a condo. So we might have to get a down payment to get them into their first house. And I just kind of bring it up. Do you know anybody that might be able to lend you money, or gift you money?
You better get that verbiage right, buddy.
Can anybody gift you the down payment? Or can anybody maybe possibly co-sign with you? They might feel more comfortable if they're on title, if they're going to gift you funds. And so then I just kind of open it up there. And a lot of times it's like, I don't know, buddy, like I'm the first generation buyer and, or whatever, but I just bring it up and try and be soft about it and see if they know anyone. Or
so with if there's not going to be a down payment assistance, sometimes you can get a little bit better interest rate on the first. So I'll sometimes just quietly put hey, based off of your scenario, here's some things that you could qualify and we could take action on right now. And then I'll slip another scenario in there going, and here's just a standard FHA loan, assuming that you had 3.5.
Yeah.
And sometimes when I frame it that way, people go, oh man, so this one needs 3.5. I'm like, you, or if there's a family member that can help, it's just kind of subtle. Mm-hmm. And so often you can kind of plant a seed and then they come back a day or two later and go, okay, hey, we want to talk about this more, right? Yeah. And we talk to a family member or whatever. And the key on that is, from the lending standpoint, we do consider it a gift. The donor, the family member that's helping with this gift, basically signs a letter that they're indicating that they're not expecting any kind of payment in return. Mm-hmm. So that is a requirement. And just clarify, we know things happen. We know that we get those letters back and we find out later that they did end up paying them back with a tax return or this or that. And that to me is business to be handled amongst the family. But from our standpoint, that money is donated without the intent to be paid back.
Yeah, I think it's important to highlight and show, like you said, what it would look like without the down payment assistance. Because when you're buying a home, especially if it's your first house, at least for me, you don't want to go ask family for help. There's that pride of doing it on your own, and, you've made it further in your career, you're making good income, it's kind of that next step with the family or whatever. And so, but seeing the financial benefit, possibly, a couple $100 savings per month, that might make sense to say, hey, maybe I'll go talk to mom and dad or grandma or grandpa or whoever, because financially that will actually help me out, and put me in a better spot.
I'm gaining more perspective the older I get. I know I still have fairly young kids, but I used to have that mentality too, that I don't want to ask for help. I want to do it on my own. Mm-hmm. But as a parent, if I had a kid come to me and say, hey, we're exploring our options. We can move forward like this without any help, so we have an option. But man, this payment over here is $200-300 more. We would rather take that $200 or $300 and buy a life insurance policy and increase my contribution to my 401k. And they're starting to look at it from a bigger picture. As a parent, I'd be like, man, I would love to help because I see the maturity and what you're doing with the money.
Yeah.
So I guess I'm just trying to say that my mindset has changed the older I've gotten, and the perspectives.
Yeah.
They change over time.
Yeah. I think it's just, good to give options. As a homeowner or a potential buyer, it's good to just ask questions too. So, great point, Ben.
Yeah. Okay. Well, I kind of like this topic with down payment assistance. It's a talking point out in the market right now. And again, a little call to action to the listeners. If you're wanting to know more information on any of the points we've covered in the podcast today, you can reach us over Facebook and Instagram. Happy to do a deep dive on your scenario or your client's scenario.
Yeah. And then one quick thing I just thought of before we end the podcast is if you mentioned, if your child is looking to buy, even if your child, say, is in college or, they're still just starting their career, maybe they don't have enough income that they can qualify to buy. If you're going to possibly help them get into a place, they can go on to the loan and not have income and still have it be a primary home. You can get the minimum down payment, or they can take advantage of a down payment assistance and still get those better terms by being on the loan. So I think a lot of times if the thing we see here a lot with the university is, their child's going to go to school for 4 years. They don't want to pay, student housing for 4 years. They may want to, buy that home with their child, and you can do that, put them on the loan and get the benefits of these first-time homebuyer, products. And then after 4 years, if it converts to a rental property or you sell it, maybe you just give it to your child or whatever. That'd be awesome. If you had a super rich family, that's an option.
Let me tell you a really cool scenario. There's a gentleman I know that told me what he did for all of his kids when they went to college, and I just thought it was really cool. I hope that I'm in the position to do something similar to this. Some parents set aside in a 529 plan or whatever and help cover tuition or housing for a kid as they go chase their degree. His point was a little different. He said, hey, this is the way that I'm going to help you with your education. I'm going to help you with a down payment for whatever town that you're living in. We'll buy a home together. You will occupy it. And you are going to manage that. You're going to rent out the other bedrooms to other students. You're going to collect payment. You're going to learn some business aspects and responsibility with that. And then you're going to have to go get some student loans for your school. But when you're done, fast forward 4 years, you graduate, you'll have a choice. You can either sell that house, use the equity, the appreciation to turn around and pay off your student loans, or choose to move out of that house, convert it to a rental, and now you have rental income for the rest of your life. But I love that he gives them choices. It's forcing them to navigate in their mind what is the best use of money and how does this fit into a strategy. And there's some business responsibility and accountability. And I just think it's a little bit different than just cutting a check for tuition. But yet, do the monies actually pencil out to be similar? Absolutely. So just a cool, different concept. But the guy used the exact loan program that you're referring to there, where the old terminology used to be FHA kitty condo. Mm-hmm. The occupant didn't have to put have any income into the transaction, just needed a credit score and be the occupant. So cool strategy, just another kind of a cool case study.
Yeah, cool hack and a cool way to, with that child, give them sort of an asset and an investment, especially just starting a career and getting going in life. Yep. So that's really cool.
Cool.
Sweet.
Well, that's a wrap.